All right, you are live.
Good morning. This is the meeting of the City of Annapolis Police and Fire Retirement Commission, previously scheduled and for which notice was published. We are calling the meeting to order at 8:34 a.m. A quorum is present. I would like to take care of some housekeeping items. We'll begin by first looking at calendar year 2024. I am proposing that we will hold our meetings every other month on the fourth Tuesday of the month, beginning in January, which would be January 2023 as the first meeting date. Before we finally set that and turn it into the city, which we need to do so that we can arrange for technical support to continue doing these, but as virtual meetings, I would ask all commission members to get back to me with conflicts so that we can look at them and try to ascertain whether or not that proposed schedule will work. Assuming that we have what appears to be quorums on each of those days, at this point in time, we will designate the fourth Tuesday of every other month as our official meeting date. And Nikki and I will reach out to those members who are not with us so that they can check their calendars as well. Moving forward from that, minutes of the open session meeting were circulated prior to this meeting. Does anyone have any comments, corrections, anything they want added to those minutes or deleted? Otherwise, could I please have a motion to accept those minutes?
Motion to accept them.
May I have a second? And
Second.
All in favor, aye.
Aye.
Is there anyone opposed? Not hearing that any opposition, and those all in favor, the minutes of September 13, 2023 are accepted. With that, I'm going to ask Mr. Jones to give us a quick review of the investment markets so that we can get a sense of where the economies are generally, and then we will go into closed session and look at our portfolios and see if we need to make adjustments there. Ian, would you please go forward?
Thank you, Joe, and good morning, everyone. So I'm going to share my screen. First of all, as I mentioned yesterday, I apologize for the late delivery of reports yesterday, and it slipped by me, and I'm sorry. So we have a snapshot of the investment markets as of October 31, and the markets, were great through July 31st. The S&P was almost back up to its full recovery high prior to the drawdown in 2022, but we've given back some of that ground over the past couple of months. And so when you look at the year-to-date column, you see the equity indices, and the S&P still looks pretty good. It was up roughly 10.7% for that 10-month period, but it doesn't really tell the full story, and I'll get into more of the story and as we go through. But the market has been more challenged. When you look at mid and small company stocks, the Russell indices were negative. Mid cap was down roughly 1.3, and mid cap was down about 4.5%. Then the story sort of unfolds when you look at growth and value. And you can just see a huge difference in performance with the Russell 1000 Growth Index being up more than 23% and value at negative 1.8. So the takeaway there is that if you didn't have growth exposure, and specifically if you didn't have exposure to a double handful of companies that generated the bulk of the index's return, then you didn't participate in the upside as reflected by an index like the S&P 500 or the Russell 1000 growth. And I'm going to show you a little bit more granularity on that in just a minute. The international markets, the developed international, which is the MSCI EAFE index, was up 2.75%, but the emerging markets were down a little bit more than 2%. On the fixed income side, we've had slightly negative returns. Investment grade bonds, as represented by the Bloomberg Aggregate Index, were down roughly 2.8%. Investment grade corporate bonds were down a little less than 2%. The bright spot has been in the riskier part of the market, high yield bonds, and high yield bonds were up 4.6%. But basically, the dynamic at play has been that the government, as a result of the data that they're seeing, has said we're going to keep interest rates higher and for longer. And as a result of that, interest rates in general have gone up. And when rates go up, the value of fixed income securities goes down. And so that is what is attributable to the negative returns coming from the high quality investment grade part of the market. But the reality is that the economy has still been pretty strong and resilient, even with higher interest rates. The consumer has been continuing to participate in the purchase of goods and services, and that has helped companies have relatively favorable earnings. And as a result, particularly the higher yielding companies, which are yielding 8 to 9%, they have generated a yield-oriented return, and that's what's attributable to that return of about 4.6% through the end of October. But in today's world, yields do matter in comparison to where we were, roughly 2 years ago. And you can see there's a term called yield to worst. And think of that as being yield to maturity. And when you look at the underlying yields of bonds within these various indices, investment grade bonds have a yield to maturity or yield to worst of about 5.65%. High yield bonds have a yield to worst of 9.5%. And that means if no one goes into default, if you hold the bonds to their average maturity, if you hold a high yield index to the average maturity, you're going to get about a 9.5% return as a result of the underlying yields of the bonds in that index. So hopefully we are going to see some better returns coming from the fixed income side of the portfolio if we can avert any additional interest rate increases or rising interest rates as we've experienced over the past 2 years. Any questions on the market environment?
And in terms of historic interest rates, this looks like it's returning to normal pre-2020. If you look back over a 50-year period, am I mistaken on that? For most of my lifetime, I thought interest rates tended to be a little higher than this, with things like mortgage interest rates being between 7 and 8%.
I think that when you look at real rates of return, which is the current yield minus the inflation rate, I think we are, closer to sort of historic averages. The government would like to get inflation under control and have rates come down a little bit, but yeah, you're closer to, I'd say, on the investment grade side, historic averages back, 50 plus years. I have a little more detail through November 10th, which is last Friday, and we had a pretty good run over the past week plus, and basically, when the Fed met 2 Wednesdays ago, there was an indication that maybe they are done with interest rate increases, and the markets have responded favorably with that sentiment coming from the Federal Reserve. So when you look at the year-to-date column, the S&P through last Friday was up 16.6%. And you can see in the month of November, pretty positive returns coming from domestic equities. The S&P has been up in November more than 5%, mid cap more than 3%, and small cap about 2.5%. You still have this leadership, though, coming from the growth side. Large cap growth was up more than 32%. And value, now you're back positive, but you're only up 0.75%. And the storyline there is really spelled out. Oh, and you've had a pretty positive bond market. So yields have dropped. And, for a 10-day period of time, getting a 2+% rate of return coming from bonds is a decent return over a small number of days. And that's because interest rates have fallen. But the growth side of the market has been dominated by what are called the Magnificent Seven stocks. And I've thrown in Netflix in here as well. But you can see returns between 40 and 230%. And this is for, from January 1st through November 10th. And so if you don't own these names, you haven't participated in the market's upside. And that is further demonstrated on this chart. And this chart looks at the period from June of 2022 through September of 2023. And so if you remember, 2022 was difficult for growth, and we had a downward slope with that red part of the chart for the large cap growth part of the market. But then it's all been up since December of 2022, where that part of the market has gone up, as I said, 30+%. And if you look at the Magnificent Seven stocks down below, those stocks, this is for the 9-month period from the beginning of 2023 through September. And those 7 stocks have returned more than 51%. The S&P has returned 13+. If you take the Magnificent Seven out of the S&P is only up 2.5%. So those 7 stocks have accounted for more than 10% of the S&P 500's rate of return for the 9 months of September through September of 2023. Any questions there? So this chart simply looks at a longer period of time. It goes back to just before the global financial crisis. And the blue parts of the chart represent market losses of 5% or greater. And the green part of the chart are periods of recovery and upward trajectory of the S&P 500. And basically, the takeaway is that the market goes up more than it goes down. But when you're invested in publicly traded equities, we do have bumps in the road. But the challenge has been over the past decade plus, we've had a number of bumps where we've had significant market drawdowns as reflected in the areas where I'm putting a red box around them. And that makes it difficult, particularly when you have a benefit plan like the retirement plan that needs to pay benefits month in and month out. When you're drawing upon your asset base, when the market is down, you're basically digging the hole deeper, and that makes it difficult for plans like the retirement plan. But in general, over this period from October of 2007 through the end of September of 2023, the S&P has returned 8.8%. And got another chart. This looks at bull and bear markets over a longer period, going back to January of 1945. So over this time, the S&Ps returned 11.2%. A bear market is where the market goes down by 20% or more, and a bull market is where the market goes up by 20% or more. There's been 14 bear markets, 14 bull markets, and the green are the bull markets. They dominate the bear markets. And part and parcel with what I just said, you sort of have to live through these difficult bear markets in order to get the full potential of the bull markets over the long term. So, my sentiment here is you have to be patient in order to receive the upward movement of the market and live through these red periods, which are difficult, but we eventually do recover. This is simply a histogram. I'm not going to go over this in detail, but the market is dominated by returns of greater than 20% in the S&P 500. These are calendar year returns going back to 1926. And again, you sort of have to be patient, and the market is down roughly 25% of the time, but it is positive 75% of the time. And you got to live through these red parts of the chart in order to get to the blue. And then finally is a market timing chart. And it's really difficult to determine when to be in and out of the market. And so when you look at the S&P going back almost 4,000 trading days back to October of 2007, the S&P over that entire time period has returned 9.2%. But it's really interesting. If you miss the 5 best trading days over roughly those 4,000 days, your return goes from 9.2 down to roughly 6%. If you miss the 10 best days, your return goes down to about 4%. The 15 best days, it goes down to about 2%. And the 20 best days goes down to 0.66%. Now, conversely, if you miss the worst days, your return goes up. But the point is that a small number of days account for both the upside and the downside. Really, really difficult. If anyone on the call thinks they can pick those days and when to be in and out, you're fooling yourself, because it's not. If we could, we would do it all the time, and that's why we sort of have to stay the course. And Joe, that concludes my market commentary.
I would ask for a motion to go into closed session at this point so we can relate this to our portfolio.
Make a motion to go into close.
May I have a quick second?
I'll second.
Okay, those in favor, aye.
Aye.
Anyone opposed? And with that,